Hello everyone, and welcome back. Today we are diving into a phenomenon that is currently confusing, delighting, and surprising property buyers all over the country. If you've been following the headlines in these early months of 2025, you know the big news. Major banks are finally slashing their mortgage rates. It's the moment we've been waiting for. But there is a secondary story here, a subplot that is arguably more important than the rate cut itself. Here is the scenario. You went to a broker in January. You ran the numbers. The computer said no, or maybe it gave you a borrowing capacity that wouldn't even buy a shoebox in the suburbs. You felt defeated. Fast forward to now. You haven't got a pay rise. Your savings haven't doubled. But suddenly, that same bank is rolling out the red carpet, approving loans that were impossible just 3 months ago, and offering loan amounts that are significantly higher. Why? What changed in the mysterious black box of bank algorithms? Today, we're going to peel back the layers of the banking system. We aren't just going to say rates went down. We're going to look at the 3 specific mechanisms, the gears, that turn inside a bank's credit model when the Reserve Bank pivots. By the end of this episode, you'll understand why your borrowing power just got a turbo boost, and why, if you were rejected earlier this year, you need to pick up the phone right now. Part 1. The invisible hurdle, the assessment rate. Let's get straight into the technicals. The first, and frankly the most powerful reason your borrowing capacity has skyrocketed, has to do with something called the assessment rate, or with a stress test buffer. When you walk into a bank and ask for a loan, you might think the bank is looking at the advertised interest rate. Let's say it was 6% prior to these cuts. You think, can I afford the repayments at 6%? But the bank doesn't care about 6%. They are legally and ethically required to ensure you can pay the mortgage if things go wrong. So, they don't test your ability to repay at the actual rate. They test it at the actual rate plus a buffer. Historically, and in recent times, this buffer has often been around 3%. So let's do the math on the old world of 2024. If your actual interest rate was 6%, the bank was stress testing your finances at 9%. That is a massive hurdle. It means your income had to be high enough to support a mortgage that was essentially 50% more expensive than reality. Now, let's look at what is happening in 2025. The banks have lowered their rates. Let's say the actual offered rate has dropped to 5%. On the surface, that's a 1% saving. Nice, but not life-changing, right? Wrong. Because of the buffer mechanism, your assessment rate has also dropped. If the advertised rate is 5%, and the buffer remains constant, the bank is now stress testing you at 8% instead of 9%. In the world of credit risk, a 1% drop in the assessment rate is monumental. It lowers the bar significantly. The bank's algorithm looks at your income and realizes that at an 8% theoretical rate, you have significantly more surplus cash than you did at 9%. This mechanism alone, the dropping of the assessment floor, is the primary driver of why the system calculates that you can borrow more money. It's not just that the loan is cheaper, it's that the hurdle you have to jump over has been lowered. I want to expand on this because it's often misunderstood. People think borrowing power is linear. It's not. It's exponential. As that assessment rate drops, it frees up a disproportionate amount of your income to be counted towards servicing. It essentially unlocks a tranche of your salary that was previously quarantined for safety, allowing it to be used to service debt. Part 2. The cash flow effect, real disposable income. Now let's move to the second gear, real-world cash flow. While the assessment rate is a theoretical calculation, the second factor is about the cold, hard cash leaving your bank account every month. We call this the serviceability reality. When rates drop, your monthly repayment on any existing debt drops, or the projected repayment on the new loan drops. This creates a surplus in your monthly budget. For an owner-occupier, someone buying a home to live in, this is straightforward. If the interest rate drops, you might be saving several $100s every single month compared to the previous high-rate environment. Banks are obsessed with something called NDI, net disposable income. They take your gross pay, subtract taxes, subtract living expenses, often using a benchmark called the household expenditure measure, and then subtract your debt commitments. When rates fall, that debt commitment number shrinks. This means you have more uncommitted monthly income. To a bank, uncommitted income equals safety. It means that if your car breaks down or you have a medical emergency, you have a buffer of your own. Because your life burden has essentially become lighter, the bank is willing to load you up with more debt. It sounds counterintuitive. You have more spare cash, so here, take more debt. But that is exactly how lending works. They're capitalizing your surplus cash flow into a higher principal loan amount. But what about investors? This is where it gets really interesting. If you're looking to buy an investment property, the math has shifted in your favor even more aggressively. Consider the equation for an investment property. Income, which is rent, minus expenses, which are interest plus maintenance. In this 2025 scenario, rents have likely remained stable or are still increasing. They rarely go down. However, your biggest expense, interest, has just dropped. This improves the debt service coverage ratio. Previously, the bank might have seen a property as a heavy liability, something that would cost you $1,000 a month out of your own pocket to hold. That hurts your borrowing power for the next loan. But with lower rates, that same property might now only cost you $500 a month to hold, or it might even be washing its own face, neutral gearing. The bank sees that the asset is self-sustaining. The holding cost has decreased. This implies that your ability to repay the loan is stronger than it was before, simply because the interest bill is lower while the rental income remains robust. The same brick-and-mortar asset is now viewed as a safer bet by the lending software. Part 3. The psychology of the bank, risk appetite. We talked about math. Now let's talk about psychology. Specifically, the psychology of the Big Four and the second-tier lenders. We often think of banks as unfeeling machines, but they are businesses driven by strategy, market share, and fear. The third reason you can borrow more today than you could a few months ago is that the banks want to lend to you again. Let's look at the macro picture. Why do central banks cut rates? They do it to stimulate the economy. A rate cut is a signal from the central bank that it's time to get money moving again. It is a signal that the extreme inflationary risks of the past few years are subsiding. When the economy is in a tightening phase, which means that rates are going up, banks run for cover. They tighten their credit policies. They scrutinize every coffee you buy. They are terrified of default risk. But when the cycle turns, as it has now in 2025, the risk parameters inside the bank's internal models are adjusted downwards. Banks are currently in a race for market share. During the high-rate period, loan volumes collapsed. Nobody was borrowing. Banks make money by selling money. If they don't lend, they don't profit. Now that the signal has turned green, lenders are entering the market aggressively to regain their slice of the pie. What does this look like for you? It looks like policy exceptions. It looks like lenders accepting 100% of your overtime income instead of 80%. It looks like them ignoring certain small debts or being more generous with their living expense estimates. In a high-rate environment, the answer to a borderline application is no. In a falling rate environment, the answer to that same application is often, let's see how we can make this work. The source material highlights this perfectly. Emerging loan policies that were previously dormant are being rolled out to help lenders compete. They're loosening the screws on the risk engine. Part 4. The wealth effect, valuations, and equity. There's a fourth factor here that acts as a force multiplier, which we touched on in the summary. The valuation of the underlying asset. When rates drop, borrowing capacity rises. When borrowing capacity rises, people bid more for houses. When people bid more, property values go up. This creates a positive feedback loop for anyone who already owns a property. Let's say you own a home that was worth $800,000 last year. You wanted to tap into your equity to buy an investment property, but the bank said your loan-to-value ratio was too high. Now, thanks to the rate cuts stimulating the market, that house might be valued at $850,000 or $900,000. Simultaneously, the bank's valuation confidence has increased. In a falling market, bank valuers are conservative. They're scared to overvalue a home. In a rising market, stimulated by rate cuts, they are more likely to give you the figure you need. So, you have a situation where your asset is worth more, higher collateral. Your monthly payments are lower, better cash flow. The stress test is easier with a lower buffer. It is a triple threat of borrowing power. This is why the change feels so sudden. It's not one lever being pulled. It's the entire machine realigning in favor of the borrower. Part 5. The danger of old math. I want to pause here and address a very specific danger. The danger of old math. Human beings are creatures of habit. If you were told no in November 2024 or January 2025, that rejection creates a psychological scar. You assume that is your reality for the year. You might be sitting on the sidelines right now, thinking you need to save another $20,000 before you try again. Meanwhile, the market is moving. The rules of the game have changed while you were sitting on the bench. As our source points out, if you evaluated your borrowing capacity at the start of the year and the result was less than ideal, that result is now obsolete. It is data from a different era. The combination of the lower assessment rate, the improved cash flow model, and the bank's hunger for market share means your budget could be $50,000, $100,000, or even more, higher than it was just a few months ago. Part 6. A strategic warning. Before we wrap up, I need to add a layer of caution. Just because you can borrow more doesn't always mean you should. We are discussing the mechanics of capacity, what the bank says you can handle. However, you must always run your own personal budget. The bank uses averages and algorithms. Only you know if you're planning to have triplets next year, or if you want to take a sabbatical to travel the world. The bank's newfound generosity is based on their risk appetite, not necessarily your life goals. That said, if your goal is to enter the property market or upgrade your home, this credit expansion is the window of opportunity you have been waiting for. Conclusion, your next step. So, let's bring this all together. 2025 has brought a pivot. The headwinds of high interest rates and tight lending standards are shifting into tailwinds. To summarize, your borrowing power is rising because the math changed. The assessment rate, which is known as the buffer, has dropped, lowering the bar you need to jump over. The cash flow improved. Lower actual rates mean more disposable income in the eyes of the bank. The banks are hungry. Lenders are signaling a risk-on attitude and releasing looser policies to capture market share. Here is my challenge to you for this week. If you have a broker, call them today. Do not rely on the email they sent you 3 months ago. Ask them specifically, with the recent rate cuts and the adjustments to the assessment buffer, what does my capacity look like now? You might be surprised to find that the dream home that was out of reach in January is suddenly within your pre-approval limit in April. The rules have changed. Make sure you're playing by the new ones. That's it for this video. If you found this helpful, please share it with a friend who is struggling to get into the market. Thanks for listening, and I'll catch you in the next video.